Okay, good afternoon and welcome back everyone to our Thursday afternoon market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to do largely a review of what we learned here in the month of March and also discuss what we currently view in terms of the market outlook and provide you with some insights into some of the new things that are launching that you have access to as a member here at OptionsPlay. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we have quite a bit on the calendar coming up. Tomorrow morning, we have our next thematic investment series. We're going to be covering 5G and IoT, Internet of Things. This is a pretty broad topic, and there's a lot of different companies that operate within this space. So interesting to show you kind of the developments that we see in this particular space and the type of companies that we think are going to do well within the new upgrade cycle with 5G and just the automation around the connection of so many more devices to the internet. For next Thursday, we're doing a special session. Next Thursday, instead of doing our normal session at 4:15 p.m., we're actually going to do a live trading session with Pete Beaumont from the Small Exchange. So this is going to be 11:30 a.m. next Thursday. And we're also doing it earlier in the day next Thursday because Good Friday is the day after. So we're doing it earlier in the day. We're going to do a live trading session. We're going to do some futures trading together. We're going to use the small futures. Those of you that joined us here a couple of weeks ago here with Tom, we're going to be doing a similar type session, but again, it's going to be live during the trading day. We're going to be placing some trades and showing you, how you can gain exposure to different asset classes using the small futures products. And then for the month of April, we're going to just talk about buying options. We're going to talk about buying calls, buying puts, buying debit spreads, buying calendars, buying diagonals, really making sure that you understand all the best practices when it comes to buying options. And then in May, we'll cover selling options. So really kind of focusing on one type of trading strategy so that you can understand it, make sure that you understand the different strategies, the different variations, so that you can learn how to utilize these strategies for your portfolio. And then, like I said, in May, we're going to do selling calls, selling puts, selling credit spreads, selling these types of strategies to give you a better understanding as to how selling option strategies can be utilized in your portfolio. And then at the end of April, we're going to be doing an introduction to index options. We don't talk a lot about index options here, so I want to make sure that we start getting users familiar with trading index options. What are the benefits of index options versus ETF options? Introduce some products that you can trade and understand the differences between trading a stock or ETF in option versus an index option. A lot of the concerns, probably one of the most common questions that I get from investors with trading spreads are investors who are concerned about an early assignment. So when you trade index options, you don't have to worry about that. They're cash settled. They're European options. You can't be assigned early. So for those of you that like to trade spreads, index options is a asset class that you might want to take a look at. So what we're going to discuss here today is we're going to first take a look at the broader market update, just take a look at where we currently sit within equity markets. We've had a pretty choppy few weeks or so, not a strong directional view, bullish or bearish, but fairly choppy. And the question is, where do we sit now? Is this going to be the bottom here? Are we going to start looking for long opportunities, or do we think that it's time to start, or we think that there's further downside? Then we're going to do a quick review of the things we learned here in March. First, talking about the paper trading with OptionsPlay. Again, for those of you that are new to options trading, or if you're new to a specific strategy that you want to try out, the paper trading feature that you can have, that you have access to at OptionsPlay, is designed to allow you to test out different strategies, track a trade over a period of time before you actually deploy it for your own trading strategy, for your own portfolio. Then we talked about credit spreads last week. So we talked about optimal credit spreads, managing credit spreads, and finding the options edge using the credit spread opportunity reports. We're going to do a quick review of that. And then I want to show you a new feature that we just launched, the OptionsPlay Hub. We got a lot of questions from investors asking us, where do they find the recordings for the webinars? Where do you get access to all the reports? So we've consolidated everything into one place for all members called the OptionsPlay Hub. I'm going to show you how to get access to it. And then at the end, we'll open this up for Q&A. So the primary question that for investors who are looking for, from a market outlook perspective, the question that we seem to be getting right now is, should we expect more choppy trading ahead? We've had a lot of chop here over the past month, pretty much since the February 16th highs. We've gotten a lot of chop, and the question is, do we expect this to continue going forward? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, my relative strength and rotational research to help answer that question as far as where markets are and where do you find opportunities in this market, and then share with you, a review of what we learned here for the month of March. So let's start with taking a look at just the broad-based markets where we currently sit. So here's the S&P 500, still very much in the strong uptrend here. The daily chart seeing quite a few pullbacks here over the past few months. Not very, this current pullback that we're seeing, not very deep, actually, only a few percentage points. We're only down about less than 2% from that all-time high here in late March, and just less than 1% from the February 15th highs, February 16th highs here. So the S&P 500 still remaining in the strong bullish trend here, holding so far new higher lows, higher highs, which is constructive of a continuation higher here for the S&P 500. Now the Qs, the technology index, not as strong, a significantly stronger pullback here from March, from the February highs. The March bounce did not reach anywhere close to the February highs the way the S&P 500 did. So the technology is certainly under pressure here, and so far holding relatively okay here at the moment. Now, at the moment, I still think that there could be a little bit more downside to this 298 support level here, but to that is pretty much the extent that we see here to the downside for the NASDAQ 100 index, which has been a pretty strong support or resistance level here since the November elections, if you will. So this 298 level, 300 level is really the bottom that we could potentially still test here for technology shares. If you look on overall on some of the major technology names, they still look like there's a little bit more weakness. They could potentially still have a little bit more downside here. So the S&P 500 looking significantly stronger than the NASDAQ 100. And then when we look at small caps, we really saw small caps fall apart a little bit here yesterday, but largely still remaining intact here. We have a very strong uptrend here for the Qs, for the IWM. We've had subsequent higher highs, and then we've had effectively equal lows. But we have bounced off of this 208 level here, which is this support level that you would see right here. Today bouncing off of those levels. So this is still at the moment neutral with a, I would say, slightly mildly bullish view here, especially as we're trading near the bottom of that channel. Our expectation is that we might trade towards the top of that channel. We really need to see a break above 235 or so, 234 or so for this to continue moving higher. But when we're trading near the bottom of the channel, our views are more mildly bullish than mildly bearish. And lastly, looking at RSP, the equal weight S&P 500 index, this also continues to be very constructive here. You have the February highs, which we actually exceeded that after the February 16th highs. And then the March highs were even exceeded the late February highs. And right now we're still holding those late February highs above that level. So what this tells me is that the broad-based market, the market breadth here on this current on the current market rally is still strong, right? The RSP is the equal weight S&P 500 index, meaning every single stock within this index has an equal weighting. So the smallest stocks in the S&P 500 have the same weight as the largest stocks in the market. When we look at SPY, that's a market cap index, meaning the size of the company determines the weight that it has within the index. So when you have the equal weight index outperforming the market cap index, what that means is that the vast majority of the names in the S&P 500 are actually moving higher, while the big cap names are moving more sideways. So the weakness is coming from the mega cap names, and the strength is actually coming from the smaller names within the S&P 500. Now, when we see that, that is generally speaking fairly strong for the market rally when you have market breadth across the board rallying. So when we look at all of that information on balance, the choppiness that we have seen here in the markets here over the past month, while it's been difficult to trade, right? There isn't a strong sense of direction. You kind of get whipsawed one way or another. But when we look at it on balance, this large bullish trend is still intact. So I think there was a question here before we got started regarding my views of the market. This is my view that the bullish trend is still very much intact. We have gotten a little chop here, which is to be expected after such a strong move. I mean, you've had a move from 228 to 390. We're talking about a pretty big move here to the upside. You're going to have a little bit of chop, a little bit of consolidation through that. And arguably, this isn't that much chop, in my opinion. Where you really have seen some compression here is on the technology stocks. And this is part of why we've largely stayed away from the technology stocks to the upside from these names until just now. We're starting to step back into some of these technology names, looking for some upside. And we'll take a look at the sector rotation data to show you why, we've been defensive here for the past month or so, because sector rotation clearly shows us that within this chop, when markets are moving sideways, you want to know which sectors are moving higher and which sectors are moving lower, because as markets move sideways, it doesn't mean that all the individual stocks within that market are also moving sideways. What we see is that there's plenty of stocks that are rising and plenty of stocks that are moving lower. And then when you average them out, the market kind of moves sideways as a result of that. But when you look underneath the surface, this is where we look at sector rotation data. Sector rotation data gives us a sense which sectors are strengthening and which sectors are weakening. So for the past 4 months or so, we've really had financials and energy lead this market higher. With the rising rates and the rise in crude prices pretty much since the start of the election, you had financials and energy leading the way higher. But as you can see here over the past few weeks, and we've been talking about this, financials have really started to come down and energy really started to weaken here. Energy and financials really kind of starting to lag behind. They're not quite there yet, but certainly heading in that direction. We had communications, industrials, and materials, which started a bit of leadership here, but didn't last very long. All three of these sectors were in kind of leadership positions for less than just a couple of weeks or so and starting to weaken a little. But we did see materials and industrials come back to life again today. This is actually one where I do expect that we could potentially see these get back into this leading category here, because just from a cyclical and a fundamental perspective, it makes sense to see industrials and materials lead this market higher. But the data actually shows us that it's the defensive sectors. These are the ones that we've been focusing on for the past few weeks. The more defensive sectors, utilities, real estate, consumer staples, are the ones that are leading. We have consumer discretionary starting to improve, but as you can see, it's already starting to fall behind a little. So consumer discretionary, not as strong as utilities, real estate, and staples. And we do have technology, as you can see here, this is the map here for technology, starting to get into that improving stage. So this is really where we can start stepping in, taking a look at some technology names. It's not quite in that leading category yet, but it's making that ground up right now. And also healthcare. Healthcare hasn't been particularly strong, but it also hasn't been weak. It's what we call a bit of a stealth rally here. So healthcare kind of moving a little bit, improving a little bit, improving a little bit, then declining a little bit, and now improving a little bit, maybe starting to get into that leading category. So right now, our focus is more on the stronger sectors like consumer staples, utilities, real estate. We have technology coming up. So when we're looking for opportunities in this market, the reason that we haven't really seeked many bearish opportunities is because we don't see a lot of strong bearish views on the broader markets. If you look at the long-term trend here, it's clearly we're not in a bearish market here. This certainly came under pressure, but this was a very short-lived correction here. It quickly bounced back here, and you just have a bunch of chop here. This is not bearish by any means. If we start breaking below 298, then I would agree with you that we are now entering some bearish tones here, specifically from the higher higher beta tech names here, but largely we have not broken any support levels. These trends are still intact. At best, you can say that markets are neutral, and especially in this neutral market, what you want to pay attention to is that sector rotation. You want to know which sectors are strengthening, which sectors are weakening, and you rotate within these sectors when the markets are neutral. Once you have a bearish view or a bullish view, that's when you can then lean more towards bullish or bearish views. So that's how we're currently viewing the market at the very moment. So with that, let's take a look at some of the things that we reviewed here for the month of March. So we started off the month of March, or actually we ended the end of February with looking at some paper trades, and we reviewed them in March. So this is, again, for those of you that have not joined us here before, if you're using OptionsPlay and you're using it for the first time to place some trades, let me bring up OptionsPlay. Actually, I don't have it up. One second. Here we go. So if you're looking at OptionsPlay, one of the things that investors have been asking us for are paper trading, especially when it comes to stocks that or strategies that you're just learning. Many investors here are learning new strategies as you join us for these Thursday education sessions. And you're thinking to yourself, okay, I've just learned the strategy. I'm interested in it. How do I test it out? So we showed you how you can paper trade a strategy, and you can type in any stock, you can set up any symbol, you can click on modify, you can construct any symbol you can possibly think of. If you've never traded an iron condor before, maybe this is your first time getting into an iron condor, so you want to test it out before you trade a real strategy here, you can use the tool to create your iron condor, and then you can click on the blue share button, and that allows you to potentially save a trade using this link button here on the upper right-hand corner. When you click on this link button, what it does is it saves the trade in your profile, just like a paper trade. And what you can do once you save a trade is you can go into your profile, and there's a section called Shared Trades. And when you click on that, it'll show you all the trades that you have previously saved. And you can think of these as paper trades. And when you click on one, you'll be able to see the trades that you have made and see how they have performed since the time that you saved them. So this acts, again, as a paper trading mechanism for any strategy that you're trading. So here is a consolidated Edison trade that I was looking at. We had at this time bought the 67.5, 77.5 call vertical here. And as you can see, this trade is currently up $245. So it allows you to take a look at trades that you've made in the past, see how they're performing since that has happened, so that you can kind of view a trade and follow a trade, especially, again, if it's a trade that you've never traded before, or if it's strategy you've never traded before and you want to test things out before you place a live trade in your portfolio. So very, very valuable tool. I hope during this month of March, for those of you that joined us here in the beginning of March, you were able to utilize this tool a little bit for your trading. And if anyone here on your chat, if you have used a paper trade here over the past month after our sessions, please type 1 into the chat window. I'm curious how many of you have actually leveraged this tool to track some trades. Oh, I see a lot of ones. Wow, that's amazing. I didn't think there was going to be that many people, but great. I'm so glad that so many of you have been able to utilize the paper trading tool, because it is a tool that's very valuable and allows you to kind of, even if you're not paper trading, even if you're just trying to save a trade that you want to remind yourself of later, and you're thinking to yourself, I don't want to place this in a live trade, but I want to see if I'm going to be right in the long run. This is one way that you can do that. So great. I love the fact that so many of you have used it. So let's now just do a quick review of just kind of, two strategies that we discussed here, debit spreads and credit spreads this month. Just a very quick review of debit spreads. They're fairly simple, and we used them in our examples, in the paper trading examples. I think we used Facebook, Tesla, and Uber. Those are the three trades that we made on our paper trading trades. We used call options, we used debit spreads, we used credit spreads. So just a quick review of these strategies regarding best practices for entering them, what they typically look like, and how to manage them. When we talk about debit spreads, we usually go out about 60 days from expiration. And we buy the 50 delta call. So we buy the at the money call or put, and we sell the 20 delta call or put against that. So just to give you a quick review here of that, let's go through the OptionsPlay tool, and we can pull up any strategy here. Oh, whoops, I closed out OptionsPlay. Let me bring that back. So let's use Facebook, for example. Whenever we're buying a debit spread, we always want to buy the at the money spread. So the at the money strike is roughly the 50 delta. So the 275, 280 here. So the 280s are actually closer to the at the money. So as you can see on your strike drop down menu, you have your strike price, you have your premium, and then you have your delta next to it. So we want to buy the at the money, and then we want to sell roughly about a 20 delta. So as you can see, the platform automatically selects the 283.15 for you because it automatically selects buying the 50 delta, selling the 20 delta. And the 20 delta means that there's a 20% chance, or in this particular case, roughly 22% chance that Facebook will be above 315 by this expiration date. That's what Delta tells us. Delta tells us not only the sensitivity that the option has to the underlying stock, but it also estimates the probability of the stock being above that price at expiration. So when we follow those types of rules, the short leg will usually offset about 20% of the long leg's premium, which means that we're reducing the risk of the trade. If we just bought the call option and we didn't sell that 20 delta call, we would have risked roughly 20% more on that trade. We would have had unlimited upside, but we would have risked 20% more. So when you trade a vertical spread like this, you're reducing your risk. In exchange for that, you're giving up some upside. Now, this is a lower probability trade. And I tend to find that many investors will sometimes say that they don't like lower probability trades. But I always tell investors, when something has low probability, then that means on the other side of it, you have relatively strong risk reward. So when you have debit spreads that have, about a 40% chance of winning, for every $100 you're risking, you're typically potentially rewarded with up to $200. So your risk reward is going to be favorable whenever you have a lower risk, whenever you have a lower probability of profit. And we're going to see credit spreads in a few minutes as to when they have a higher probability of profit, how you have a poor risk reward. Now, when you trade these debit spreads, one of the reasons that I think trading these debit spreads is really easy to manage is the fact that the rules for managing them are really straightforward. You really have two triggers as to when you might want to cut losses on a trade. You either cut your losses when you've lost 50% of the premium that you've paid, or you take profits when you've reached 75 to 100% of the premium that you've paid. So if you pay $3 for a debit spread, so $3, if you lose half of that, which is $1.50, you cut your losses. And if you make 75 to 100% a gain of that, it's $5.25 to $6, that's when you want to take profit. So the rules for debit spreads and just long calls and puts are the same. They're really simple and easy to remember. On the flip side, when you sell a credit spread, it's not much different. It's just a little bit more complicated. So when you sell credit spreads, we go a little shorter amount of time, about 45 days to expiration. When we sell the same at the money call or put. But because when we sell an at the money call or put, naked call or put, you have unlimited risk, right? Technically, on the downside, you don't have unlimited risk because a stock can't go below zero, but I still consider that very, very substantial risk, similar to unlimited risk. So what you're doing when you're selling a credit spread is you're basically buying back an out of the money call or a put. so that you can reduce your max risk. Not only does it reduce your max risk, it also reduces the amount of capital that you need to enter the trade. Because if you sell a naked call or a put, you have to post quite a bit of margin, usually in the 15 to 20% of the stock's value, in order to sell that naked call or a put. And that is sometimes can add up to be quite a bit. So by trading a vertical spread like a credit spread, you're significantly reducing the amount of capital that you need to post in order to place that trade. And when you sell a credit spread like this, you're generally going to find that the credit you receive will be roughly 33% of the distance between the two strikes. Meaning if you sell a credit spread with, let's say, a $100 put and then a $90 put, then what you're doing is you want to collect roughly 1/3 of this width. So this is $10 wide. So you want to collect roughly $3.33 on a $10 wide credit spread. That's the general rule of thumb here. And when you use that type of spread, you're going to have higher probability of profits. So many investors will seek these high probability of profit trades because on paper, it sounds like if you just have more winners, you're going to be more profitable. But that's a fallacy that I want to make sure that you don't fall into, because when you have high probability of profit trades, you have poor risk to reward. So for every $100 in potential reward, you might be trading something that's double the amount of risk. So just because you have high probability of winning, that usually means that you have very high amount of risk for the small amount of reward that you can potentially make. So don't fall into that trap of, hey, if I can make money 90% of the time, I'll be great. Forgetting the fact that the 10% of the time you do lose money, you could blow significantly more money on that one trade than the previous 9 trades that you made. That doesn't work out for you in the long run. So be careful. Don't just shoot for high probability trades. That is a fallacy that many investors unfortunately fall into. So, and then when it comes to managing these credit spreads, the rules are a little bit more complicated. But they're not, it's just that instead of having 2 rules, there are 3 rules that you use to get out of a trade. So the 3 rules are: you either take profits at 50% of the max gain, you either cut your losses at 100% of the max gain, or you exit at 21 days to expiration if number 1 or number 2 never triggers. Meaning if you get to 21 days from expiration and you never hit your take profit and you never hit your stop loss, then you exit the trade at 21 days to expiration. So just to give you an example here, let's say I sell a credit spread that's $10 wide. So the distance between the 2 strikes are $10. And let's say I collect $4 for that credit spread. So I'm collecting 40% of the width of the spread. So my max profit on a credit spread is the premium that I collect. So when I can collect 50% of that max profit, it's time to take my profits and move on. So if my max gain is $4, once I've collected $2, it's time to take my profits and run. If my max profit is $4 and I've lost 100% of it, then it's trading at $8. That's when it's time for me to cut my losses and also move on to the next trade. Now, there are times where you hold on to a credit spread. So you sell a credit spread that's 45 days from expiration. And then there are some times where as you hold on to it, you reach 21 days. And at this point, it hasn't reached your take profit or your stop loss levels. At this point, you have 2 choices. You could either close it out wherever it is, or you can roll this into a new 45-day credit spread because it just hasn't made the move that you're expecting. So you have the choice at that point whether you want to roll it or if you simply want to close the trade. So it's really straightforward. It's a little bit more complicated, but it's not too much more complicated when it comes to the rules around managing credit spreads. But that's why credit spreads is a slightly more advanced strategy. It does have a higher risk of early assignment on the trade, but largely that's why we have this last rule here. Because if you roll your trade or close your trade 21 days from expiration, your risk of early assignment is almost zero. It doesn't ever make economic sense for someone to exercise a call or a put 21 days from expiration, or even within close to 21 days from expiration, because they can always make far more money selling the option than they can exercising the option. So for those reasons, that's why we use these rules, is to help help avoid and prevent early assignment. So that covers the review of what we discussed here for the month of March. I do want to announce that we have recently just launched the OptionsPlay Hub. And we launched this because we get a lot of questions from viewers asking, where do you have access to all of the webinar recordings, whether you missed the whether you missed out on the Tuesday morning outlooks because you're on the West Coast and 6 a.m. is a little early for you to wake up every single Tuesday, or you just want to review all of the Thursday afternoon sessions, or if you miss one of the rapid fire or thematic investment series and you want to watch that, we put all the recordings on one place so that you can have access to everything all at once. All of the different reports that we have, the cover call report, the credit spread report, the straddle report, the unusual volume report, all of that is available now at the OptionsPlay Hub, as well as all of our options education. We have an options education course to help those of you that are relatively new get up and running. And you can access this all at optionsplay.com/hub. So I'll walk you through this page real quick, and I just posted a link into the chat window, but the OptionsPlay Hub, you can find that again just by going to optionsplay.com/hub, and you'll see two primary sections. You'll see the options education and market commentary section at the top. This is where you can access our Tuesday market outlook sessions, our Thursday options education sessions, and all of our rapid fire and thematic investment series that are available for members only. When you click on access now, it'll just simply ask you to log in with your OptionsPlay credentials, and you'll be able to have access to all of the members only content for those of you that are currently members. And even if you're on a free trial, you'll still have access to this during your trial period. And then all of the trading reports that we have, the credit spread opportunity report. This is something that we discussed here last week. By clicking on the tool, you'll be able to log into your, as you see, you just put in your username and password for your OptionsPlay platform, and you'll be able to access your credit spread file here. You'll be able to access your liquidity and IV ranks, your straddle reports, your unusual volume reports. All of this is available to you here at the OptionsPlay Hub. So this is so that you don't have to go to different places to find these reports. These are all created for you right here, and you can access them within the OptionsPlay Hub. So everything's available to you at this one page. Something that a lot of investors have been asking us for. So I'm really glad that we've been able to put this all together and giving you a single place that you can access for all of this information. So the next time that you want to watch a recording, you can go to the OptionsPlay Hub. You can get all the recordings, and then you can have access to all of the trading reports that we have. I will be doing a video soon on the unusual volume report. A lot of requests for that. A lot of people wanting to know what symbols are unusual volume right now. So you can see Nike today was unusual volume. PPG had a ton of puts traded on it. And you can kind of quickly see, whether the unusual volume was more calls or more puts, how much volume was traded, and we even tell you what expiration date and strike price was the highest volume on the day, so that you can quickly navigate and kind of get a sense for what type of volume was actually traded and what was unusual about it. So that is all available. Again, this is live right now. You can go to the optionsplay.com/hub today, and you'll be able to access it with your OptionsPlay credentials. So with that, that covers what I wanted to share with you here today. I just want to thank our members for supporting us and allowing us to continue to do this and continue to improve our platform. We have a lot of exciting stuff coming up. IV rank and liquidity is being added to the platform. So you'll be able to see the IV rank of each stock and liquidity at the end of next week. So really really excited to offer that. And we are working on some stuff as well in the month of April to link these reports with your OptionsPlay account, so that when you're looking at a credit spread on the report, you'll be able to click a link and it will take you over to OptionsPlay with the exact trade filled out, so that you can view it in OptionsPlay and quickly without having to manually enter into your platform. So we're working on a lot of stuff to help integrate these reports directly into your platform. So a lot of stuff coming out in the next few months. Really excited about all of that. So I did want to announce that and let people know there's a lot of stuff that we're working on, and there will be coming out very soon. But the hub is live now, and you can go and access it with all of these reports. So with that, I did want to spend a little bit more time here today answering some questions, because I know at the end of these Thursday sessions, I tend to get a lot of questions and I don't always get to go through all of them. So hopefully, today I get a little bit more time to answer some questions. So there's a Q&A button at the bottom of your screen. Please click on that Q&A button and type any questions that you have regarding options trading, and I'll try to answer as many as I have time for here for today. So Tiff, you have a lot of questions regarding kind of how the sausage is being made. You can send us an email if you want, at info@optionsplay.com. I'm happy to answer some of those questions. It's hard for me to answer all of them here right now on this webinar. Are all index options European style with no early assignment? Generally, Daniel, yes, especially the major ones that you would normally trade are all European. That is correct. Michelle is saying, I really do not understand that in a spread, we look for rich IVs with high IV. In a spread, we sell one option and buy one option. Does the volatility offset each other? Can you comment on this? So I wouldn't say that they offset each other, because, it's a good question. Michelle is asking, why does high IV or low IV matter when you're trading a spread? Because your long one, your short one, don't they just offset each other? And that's a good point. And that's why, Michelle, why I have not utilized IV rank as the only indicator as to whether I enter or exit a trade. And you guys know that I love Tom Sosnoff and I have him on all the time. But the biggest gripe that I have with him is that he teaches high IV sell spreads, buy IV, low IV buy spreads. And I'm not a big proponent of that, because as you can see, there are plenty of opportunities that have very low IV rank where you can sell a credit spread that collects 42% of the width. This is something I discussed at length here on last week's session as to why how much premium you collect out of the vertical spread is more important than IV rank. So for those reasons, that's why I don't use IV rank as a reason to say, no, I'm not going to sell, or no, I'm not going to buy. Because largely you do offset a lot of the volatility exposure, because at the end of the day, when you're trading a spread, your Vega exposure, your exposure to volatility is relatively small. Now, when you're selling a cover call, when you're selling a cash secured put, that's a different story, because you have a fairly sizable volatility exposure when you're short, let's say, a cash secured put. But when you're selling a spread like this, you have relatively little Vega exposure. So I generally agree with you, Michelle. Where can we get the sector rotation data? So I get the sector rotation data from stockcharts.com. You have to pay for this membership in order to access it, but it is available to stockchart.com members. So I take a snapshot of this so that you guys can see that data every single Tuesday when we do our market outlook sessions. How do I set up a bull put spread the fastest way, or better yet, default to a bull put spread? Bill, that is also one of the things that I'm currently working on, but I would say the fastest way is clicking on modify. And what you can do is you can click on bullish under the strategy constructor. When you click on the strategy constructor, select bullish, and then select short put vertical. As far as choosing your strike prices go, the short strike pretty much should be selected for you. The long strike, what you want to do is you want to use about a 25 delta. So as you can see here on Facebook here, this is the 255 strike. As you can see, the delta here is for 0.25. That means I would normally sell something like a 285, 255 put spread, a bull put spread here in this particular case, and you can price it based on the mid price or the bid ask price to see the difference between the two. So that's, in my opinion, the fastest way to set up a bull put spread. But we are in the process of entering a I'm neutral button that would allow you to that would show you an automatic bull put spread here for your for option within OptionsPlay. And also, like I said, we're building a way to link these trades. When you click on one of these trades, you'll be able to view it inside of OptionsPlay, already pre-filled out for you with the bull put spread already auto-populated for you. Dwayne, again, for the sector rotation data, I get that from stockcharts.com. You can get a membership there as well and access it if you'd like, but it is not available for free. Can you please quantify your scoring system, i.e. 80 and up is a good trade, but don't place that trade with scores under 70. So, here's the thing about the OptionsPlay score is that the OptionsPlay score gives you a sense for the risk to reward ratio, but even in a low OptionsPlay score doesn't mean that you shouldn't trade it. You just need to have, in my opinion, a higher conviction to trade it. Meaning, if let's say Facebook's at 278 right now, and I think this stock is going to go to 320, right? I'm convinced that this stock is going to rally and it's going to break out to new all-time highs and get back up to 320. As you can see, no matter how poor the OptionsPlay score, meaning how expensive this option is, I'm still going to make 140% return on it. The only difference here is that if this was a little cheaper, let's say this was not as expensive, let's say this was $1,700, then maybe this score would have been, let's say 85, right? A slightly better score. And then if the stock went up to $320, maybe this would have been 100 and maybe 50% return. So as you can see, the low OptionsPlay score just tells you that this option is relatively expensive. But relatively expensive does not mean that you can't trade it. It just means that the odds are slightly skewed against you. Now, the difference between 76 and 90 is not night and day. It's the difference between maybe $1,800 and maybe $1,875 and maybe $1,800. So that $75 difference on average, over the long run makes some difference, but it's not going to be the reason that you don't trade something, right? So if you're going to spend $1,875 versus spending $1,800, obviously spending $1,800 will be better. And this just gives you a sense for whether the odds are slightly tilted in your favor or slightly tilted against you based on how cheap or expensive an option is, because that's going to be the difference between something with a low OptionsPlay score and something with a high OptionsPlay score. It's not that you can't trade something with a low OptionsPlay score. It's just that you should have a higher conviction if you're going to be trading something with a higher OptionsPlay score. And just because something has a high OptionsPlay score, let's look at what's one that I can do. Maybe something like this might give you just because something has a higher OptionsPlay score. Oh, here we go. Like this, 103. That doesn't mean you should trade it, because again, the stock still has to make a move before the strategy is profitable, right? So let's say you think the stock's going to go from 278 to 290, right? So you think the stock's going to go $12 higher. As you can see here, the vertical spread, you lose money on that trade, right? No matter how cheap this option is, if you don't think the stock's going to make the move in order for the strategy to be profitable, it's not a good trade. So I understand the question, but I want to make sure investors understand that the high and low OptionsPlay score in itself does not mean you should trade it or you should avoid it. It just gives you a sense for, are the odds slightly stacked in your favor, or are they slightly stacked against you? But you still need to have conviction on the trade in terms of directional view before you can decide whether it's a trade that you can make. That's why we don't just scan for high OptionsPlay score. We get this question a lot. People asking, well, can you just show me a list of the stocks with high OptionsPlay scores? Well, high OptionsPlay scores in itself really doesn't mean that whole much. It doesn't mean a whole lot, right? It just means that maybe tomorrow this same option is maybe trading at $750 and it's relatively cheaper to $810, and it's just telling you, hey, things are cheap. But just because things are cheap doesn't mean you should buy it. So don't confuse those two things. Does the 50-20 delta spread mean that for every $1 increase, the profit of the spread would be 3 cents? It wouldn't be 3 cents. It would be 30 cents roughly, would be the net delta. So I think the question was basically, when you buy a 50 delta and you sell a 20 delta, the net delta here is 30, which means that for every $1 the stock goes up by, you would make 30 cents, roughly. Now, this delta will change, right? Delta is not static. So as the stock goes higher, this delta will increase, but so will this one. So roughly your net delta will be still 30, but it will change. It's not going to stay exactly at 30 as the stock moves higher or lower. Do you suggest out of the money credit spreads by placing the short strike below or above the support or resistance line? So Weinho, this is something we covered last week, right? So, for example, if you felt that Facebook's support level here is 255 or 260, so the question is, do we sell a lower credit spread, something like this? My answer is no, because your probability of profit on this doesn't increase that much. So for example, if I do this 280, 255, my probability of profit is $54. Now, if I do this 260, 235, my probability of profit increases by about 10%. But look at this. I am risking $2,000 to make $500. That's a pretty poor risk to reward ratio. For every $1 I'm risking, for every $1 I can make, I'm risking roughly $4. Now, in the previous example, where I was selling the 280 to 150 255s, my probability of profit goes down by 10%. But for every $1, for every $1 I'm making, I'm risking only $1.50. So for an extra 10% loss in probability of profit, I would much rather have a risk of only $1.50 for every $1 I make versus here, the chances of the stock dropping, right? Yes, it has a higher probability of dropping a little bit than dropping this much, but if it drops, I'm likely going to lose money on both trades. And I would much rather lose only $1.50 than risking $4 on each trade. The trade-off that you're making here, an extra 10% in probability of profit, in my opinion, is not worth taking on roughly 3 times the amount of risk. That is what you're doing when you're trading these out of the money credit spreads. I can't help, and I don't know how else to tell people this, that high probability of profit trades are rarely useful in the long run and rarely good for you in the long run. They sound good on paper, but in the long run, they're detrimental to your trading strategy because of how much additional risk you have to take for just that small incremental gain in probability of profit. How do you roll a trade? Great question, Tariq. There's really nothing to rolling a trade. It really depends on your brokerage firm, but all you're doing is you're closing out an existing position and establishing a new one at usually a later expiration date, and you're doing it in a single order. That's it. That's all a rolling trade is. You don't have to roll. You can just close out your position and establish a brand new one. And if you're doing it in 2 separate trades, you're still technically rolling it. We just don't call it a roll because you're not doing it in a single trade. But roll is just a fancy word or a fancy term for closing an existing position and establishing a new one, but being able to do it in a single order. And some brokerage firms facilitate this. So if you trade at TD Ameritrade, you trade at Tastyworks, they make it fairly easy to take a credit spread or a cover call or existing option strategy and rolling it, meaning moving it out a different month, moving out to the different strike price, but doing it in one order. That's all a roll is. Can't stop loss exit strategy be expressed as 2 times the credit you receive, or is there a difference I'm not seeing? Thanks. Can't stop loss exit strategy be expressed as 2x the credit you receive? So that's exactly what I'm stating here. I'm stating that you want to exit at 2 times the credit that you receive. If you want to say 2 times, yeah, that's exactly what I'm saying. 8 is 2 times the credit that I receive. So that's exactly what I'm saying. If you want to word it as that, and that makes it easier for you to remember, by all means. When you have a credit spread working in your favor, are you still required to close it or can you let it expire? Great question, Raheem. I recently posted a video on this on YouTube. And I highly recommend for those of you that have a credit spread that you think is going to expire worthless, so you think you should just let it go to expiration, there are risks that you have when you do that. So let me show you that video, because there are scenarios where you think a credit spread's about to expire worthless, and guess what? By the time you open on Monday, the market opens substantially different from where it closed on Friday, and you lose more than what you expected to lose, or you can lose more than the max risk on a credit spread. I unfortunately saw a client that had a sizable position, had a max loss of about $20,000, let it expire, and on Monday morning he opened up his account and he was down $600,000 because something came out after the close on Friday. The short leg of the credit spread was assigned. He was not aware of that, did not exercise the long leg to offset that obligation, and was long, a few 100,000 shares of a specific stock that was down 30-40% over the weekend. So it's rare, right? That's not likely going to happen to you, but you never know. Sometimes, and it's also rare that sometimes a stock reports earnings after the close on Friday. So you think that the stock expired worthless on Friday, but after the close, the news came out, and after hours, the stock moved lower or higher, and your credit spread was exercised, and you didn't know about it. And you didn't, on the other hand, exercise your long call or put. These scenarios are rare, but we have seen some very unfortunate losses that could have been easily avoided by simply closing out your credit spread at expiration. So from my perspective, there's no good reason to hold on to a credit spread within the last 21 days to expiration. You're better off rolling it, avoiding that risk altogether. I've just seen it too many times. We always think it's not going to happen to us, and largely it may not happen to you, but we have seen some pretty big losses, and I hopefully can help you avoid it by just doing that simple rule of closing out your credit spreads. That extra 5 cents that you can make on a credit spread, it's just not worth the risk. How often is an unusual activity report updated? It is updated, if I'm not mistaken, every single hour. We update the unusual volume report every single hour. Is there a leap report? There's not a leap report because you don't really need a leap report. Because leaps are only on stocks that you want to own for the long run. There's nothing that we can scan for you that gives you good leaps, because I don't know what stocks you want to buy for the long run. So there's no leap report for that reason. There are plenty of other reports, most of the reports regarding selling, because it's really the option selling strategies that we're finding rare, kind of unique opportunities, if you will, like the credit spread opportunity report. We're trying to find our credit spreads that collect more than 1/3 of the width. The general rule of thumb is you want to collect 1/3, but if we can collect 40%, then the edge is in your favor. So all we're doing is finding trades that have an edge. I can't really find a trade that has an edge in your favor when it comes to leaps, because you're buying the option. You have to have a strong conviction in a stock in order to buy an option. And I don't know which stocks you have a conviction on. Is there a reliable source for the relative rotation graph? So Michelle, it's actually proprietary. There's only one source. RRG charts is the sole source of relative rotation graphs. So pretty much anywhere that you buy it will have the exact same chart. If you're using it and they look different, well, here's the thing, is that you can do it across different time frames too. So you can do it on the weekly chart, you can do it on the daily chart. They're going to look different. So they may look different because you have different settings on it. Do you have a link to the ETF quadrant? I love this chart. Thanks for introducing it to us. If you're referring to the relative rotation chart, I'm not sure what the ETF quadrant means. Is your unusual options activity report in real time? It is in real time, and it updates every hour throughout the day. So as you can, tomorrow morning at around 10 a.m., you'll see this update, and every single hour it will update with new unusual volume. I am not able to access the hub. It asks for the login and then takes me back to the OptionsPlay site instead of the hub. Oh, so you don't click on this login button here at the top. Sorry, let me just go back. So when you're on the OptionsPlay hub page, you don't have to click on login up here because that just takes you to the application. You just click on whatever report you want to access. So let's say you want to access the earnings calendar, and then it will ask you to enter your credentials once you click on the report that you want. So don't click on login in the upper right-hand corner. Just click on the report that you want, and it will allow you to access it. Would it be possible to show short interest or days to cover in the stock? So will, that's not data that's not a data source that we currently have right now. It's not to say that we can't source it. It's something that I'll take a look at. Is there a stock? If there's a stock I like to buy at a discount on a pullback, do you think it's better to sell a naked put a month out and bring in more money, or sell one each week and bring in less money before times? Daniel, it depends on how aggressively you want to chase the stock. I would say that if you want to chase the stock very aggressively, then you can sell the 4 times a week because it gives you 4 opportunities to effectively buy the stock. If you're okay with just being patient, and I also say that it also depends on how actively you trade. Obviously, doing it 4 times in a month is going to require some active management. You're also going to not bring in as much premium. It's because, yes, you can bring in more premium if you actually are able to sell all 4 weeklies. But if you get assigned on the first week, you're not actually receiving much of a discount because you've only collected 1 week's worth of premium, versus if you sold that 1 month option, you would collect 1 month worth of premium. I usually like to try to get at least about a 2% discount, and I tend to find that you're going to have to go about 1 month out in order to do so. If you're only selling a 1 week option, you probably get about a little slightly under 1%, probably even less than 0.5% of the discount. So you're really not getting much of a discount. So it kind of negates the benefit of a short put to some degree, because the benefit of the short put is to collect some premium and collect enough yield to offset the price of the purchase of the put of the stock. And a 1 week put, you're just not getting much premium. Where do I find the unusual options activity on the site? So I just showed you on the OptionsPlay hub at the very bottom, there is the unusual volume report. I will just qualify to everyone here. I'm personally not a big believer in unusual volume. We created this report because I know a lot of you guys like it, but I will tell you, as a trader, I do not follow unusual volume. I do not believe in unusual volume, and the evidence does not particularly show that if you follow unusual volume that you will somehow magically make money. It just doesn't. It doesn't work that way. And I'll leave it at that. It's not to say, and we created it because we know many of you are interested, and I will give you a little bit some information into our unusual volume report, because it's a little different, because there are plenty of other ones. If you look on Fidelity, they have one similar to this, but the thing about their report is that they just show you everything, right? And there's a lot of small cap stocks. There are a lot of stocks here. We identify ones that are likely opening transactions. That's the one thing, right? Because a lot of the unusual volume activity out there, you can't really easily tell if it's an opening or closing transaction, and closing transaction unusual volume is useless information. So what we try to do is we try to scan for ones that we know are relatively open transactions, and we also filter out liquidity, so that we filter out a lot of the small cap stocks out of this report. So most of the names that you see are large cap stocks, or relatively larger names that you can easily trade if you did want to follow them. But I will just leave it at that, just a qualifier here. I don't use unusual volume in my trading, and I don't really believe in following unusual volume. Ron, we're in the process of adding the OptionsPlay hub to the OptionsPlay homepage. Bill, we access the sector rotation data on stockcharts.com. In the current market environment, would you recommend bull call or bull put trades? Jan, things are pretty neutral right now. I don't think bull call or bull put trades. So, if you look at the fact that volatility has spiked up here, it certainly favors a little bit more on the bull put side, in my opinion, especially things are neutral. Unless you expect things to rebound very, very quickly, I think bull call spreads are a little tougher to get, real momentum here to the upside. Bull call spreads really require a sharp move to the upside. I think markets are going to be a little bit more choppy. You get a little bit more upside, a little bit more downside, kind of more sideways motion, which is generally going to be better for a bull put spread. If you open 50 deltas credit spreads, you should have a really good directional advantage, meaning you have to get very good at call directional, right? Can you compare Sosnoff 35 deltas way of doing spreads? Fernando, yes and no, because a 50 delta, as long as the stock doesn't move any lower, you'll be profitable. And when you sell a 50 delta put, you're going to have so yeah, I'll show you the difference. And that was exactly what I was showing you here before. Sosnoff likes the 35 delta, which is the 265, 250s, right? So here, I'm collecting a 1,000 for 445. So about 2-to-1 risk to reward ratio at about a 63% probability of profit. Mine was about a 54% probability of profit. 54% probability of profit, but I'm only risking $1.50 for every dollar that you can potentially make. So you have to be better on direction, but I also have a bigger buffer because I'm collecting $1,000 in premium versus the other one I'm only collecting $500 in premium. Tom and I have gone back and forth on this, and we believe that in the long run, whether you use my spread or whether you use his spread, you're going to roughly come out the same. That's the thing, right? And he chooses his slightly out of the money spread because he does win a little bit more often, but when he loses a little bit more. So in the long run, you come out roughly net the same, but he prefers trading his higher probability strategy because you win a slightly more often, but you don't win more money per se at the end of, let's say, 100 trades. That's the difference between his strategy and my strategy. It's not more profitable. It's just that you may have more successful trades. How can we find historical information on option stock prices when the company reports earnings? Michael, most firms have to pay quite a bit of money for that historical information. There are firms that sell this to you. They usually run in the thousands of dollars to tens of thousands of dollars. SIBO has a data shop that you can go to and you can just download information. They cost a few $100s per symbol if you want to download about 10 years worth of data. Firms like us, we usually buy them in bulk, across all the symbols, but it's not easy for a retail client, in my opinion, to get access to historical option pricing. Jay, that is something that we are talking to a few brokerage firms about. When OptionsPlay recommends a spread, does the formula consider open interest and liquidity? It considers liquidity. It does not consider open interest because open interest is not a good gauge for liquidity. So we use the bid-ask spread to gauge liquidity, and we use the open interest of the whole chain, but we don't look at open interest of individual options because individual option open interest doesn't mean anything. New to options, I would like to know if a put option that I sell is far out of the money. Example, strike at 19 and the current stock is 23 and with no chance of going down to 19. And if it does, I would be happy to buy at 19 with 2 weeks to go. Do I just leave the gyrations of up and down and just wait until the option to expire worthless? Joe, if that's your strategy, then yeah. And it sounds like that's what your strategy is. Your goal is to have these far out of the money puts expire worthless. The one thing I will tell you is that when you sell far out of the money options, it doesn't really matter what stock you're looking at. Let's just say you're looking at a low price stock like Ford, and you're saying that I'm going to sell a 2-week put option that's really far out of the money. Let's say this is a $9 put option. The problem is you're taking on unlimited risk here, right? The stock could, some bad news could come out, the stock could plummet. And granted, the risk of that happening in 2 weeks is relatively low, but you never know what could happen in this, and it may not happen this week, may not happen next week. It may not happen the third time that you do this. And the question is, every single time you're doing this, are you getting paid enough to take on that risk, right? You're taking on the risk that something bad about this company comes out and the stock plummets. And the question is 14 cents at, $14 per 2 weeks suitable? I mean, this is 2 weeks. I mean, this is 2 months. If I'm looking at a week, I'm looking at 2 cents, 3 cents, 4 cents, 5 cents, right? You're not collecting much. And the question is a few bucks worth the risk of taking on a few $100s worth of risk when the stock declines? May not happen this week, may not happen next week, but this is a strategy that we call picking up pennies in front of a freight train. It works until it doesn't. It works until, and maybe when you start, or rather the success of this strategy is purely coincidental and purely based on what year you start doing this. If you started doing this in 2007, you would have been bankrupt very, very quickly because 2008 would have wiped you out, right? We all say, hey, I don't think the stock's going to go from 23 down to 19. But in 2008, that stock went from 23 down to 10 in a very short amount of time. So is collecting $10, $15 worth taking on that risk? In the long run, we generally tend to find that it's not. But if you were lucky enough, if you will, to start this strategy in 2009 at the market bottom, you would have done okay. But if you started in 2019, you would have had your face ripped off in March during this type of strategy. So there's nothing wrong with the strategy. It's just that it's purely based on luck as to whether you make money on this in the long run. I'm trying to use index futures to hedge my portfolio of long stocks and options. Originally, I got the idea from your Sosnoff webinar where you agreed that there is more cost-effective hedge versus long puts. Do you have rules for setting stops? Do you scale in and out at once? Tom, great question. I'm hosting a session here next week with Pete from Small Exchange. We're actually going to go over this very specific example. So I'm glad that you asked that, but please join us Thursday, April 1st. We're going to be talking about smalls futures trading. We're going to be talking about hedging, and we're going to answer your question during that session, Tom. Tony, can you go over the current win trade, please? It is losing, and by the rules, it should have been closed. I don't believe it should have been closed yet. I apologize if we did. Let's see. The win trade, we bought it. It's down 32%. So the rule of thumb is to close out debit spreads at 50% so this is a great example, right? So debit spread, you stop loss when you've lost 50% of the premium paid. So if you pay $3 and it's now $1.50, that is your rule to get out. So if we look at win, we paid, in this particular case, $6.85. It's now trading at $4.63, which is a loss of 32%. So we have not reached those thresholds. That's why this trade is still open. Thank you, Tony, for your analysis. Appreciate. Do you see a chance of a long-term deep correction in tech? Not yet. I don't see the reason why we would see a deep correction here in tech. Certainly the price action right now does not warrant that. Again, if we break below this 296 level, I would reconsider that question. But we do still see that interest rates are going to rise here towards the end of the year. I certainly have a long 10-year yield view here in the markets, but that in itself, and we looked at this analysis on Tuesday, for those of you who joined us on Tuesday morning. And if you haven't, I suggest that you watch that recording in the OptionsPlay Hub. We showed you long-term interest rates when they rise, equity markets still 75% of the time rise during that time. And they rise on average about 13%. So equity still can rally in this type of rising interest rate environment. That in itself is not a good reason. And price action here for the Qs, while not particularly strong, also not particularly weak. So the fact that we've made a new higher high and a new higher low is fairly constructive of more of a neutral tone here for tech. But again, if we break below 305, we break below 298, then I would revisit that view. Hi, Tony. How often is an unusual volume report updated? It's updated every hour. What advantage do you have with debit spreads versus diagonal? What advantages do you have with debit spreads versus diagonal? I would say that the advantage with debit spreads versus diagonal is that if the stock makes a big move in the short run, the debit spread will outperform the diagonal. The diagonal will underperform the debit spread if you have a move in the short run. In the long run, the debit spread will also, in the long run, they will perform somewhat similar. It really depends on what your time frame is. And it's hard to compare a debit to a diagonal spread because you have two expirations on the diagonal and you have one expiration in a debit spread. But generally speaking, diagonals underperform when you have a big move in the short run. Maybe the IV affects the different strike options differently, further out of the money, less influence. I'm not sure the question to that, Kwame, if you don't mind, which question you're referring to. Paul, the unusual options activity is updated throughout the day. Is the hub access a separate login from the regular OptionsPlay.com? No, it's the same login. You use your OptionsPlay.com login to access the hub. Fernando, thank you so much. And that is something that we are looking to add. Is closing at 21 days before expiration not a criterion for closing a debit spread? Is that for a credit spread? Yes, the 21-day rule is for a credit spread because credit spreads are the ones that are at higher risk of early assignment, because especially when you're selling an option that's close to the current price of the stock. Debit spreads don't have that problem. So that's why debit spreads, you don't have that hard and fast rule where you have to close it at 21 days to expiration. But generally speaking, for debit spreads, you do want to close them before expiration, but you don't have to close it at 21 days to expiration. Sanjeev, this is something that we're currently, we don't have any plans to integrate with Tastyworks, but that is something that we are talking to them with. As a member on the platform, I have access to oh yeah, that's just admin use, exactly. Michelle, hi Tony, looking forward to access the OptionsPlay Hub. I have a question regarding your investor psychology session earlier this month. In the presentation, you mentioned that risk associated with having too many options positioned with the same expiration date. I was hoping that you might clarify, particularly when a lot of your daily trades have the same expiration dates in a lot of instances. Thank you for your attention. So you notice how, first of all, we usually don't have more than 3 or 4 trades in a single expiration. That's it. So we have 2 trades that expire on the 22nd, 3 trades on the 29th, 3 trades on the 36th, a couple on the 57th. Notice how they're spread out. We don't have all of them expiring on the same day. When I say too many options expiring on the same day, 2 or 3 is perfectly reasonable. But having 10 expire all on the same day, that's when you're seeing yourself a little bit too stretched, especially if you're risking 10% of 2% of your account per trade. So if, let's say on this particular day, on the 29th, which is 29 days expiration, which is the April 23rd, let's say on that particular day, first of all, I have 2 long positions and 1 short position. So that right off the bat kind of changes things a little bit, right? So if I have 3 trades that are all long, that would be a little different than 2 long trades and 1 short trade, right? Because in that particular week, if let's say the markets drop, I have 1 trade that works in my favor, 2 trades that works against me, or if the market rallies significantly in that week, I have 2 trades that work in my favor and 1 trades that work against me. And notice that I have them across different sectors. I have them across industrials and technology, right? So they're kind of spread out, and they're out of and they're different types of trades, right? XLU is a neutral trade, Lowe's is a neutral trade, but these all expire on the 22nd. Looking out to the 36, I'm long IBB and I'm long DH Horton, I'm long pins. So we have 2 kind of similar type trades, IBB and pins. One's biotech and one's technology. So those 2 are similar, but DHI is in materials, or I'm sorry, consumer discretionary. So this is really where you want to make sure that you have some segmentation, right? You don't want to have 3 trades that are all in the same category. But even if you have 3 trades in the same category, that is generally speaking the limit that you want to have. You can have 2 to 3 trades per expiration. That's perfectly fine. But sometimes I see investors that have 10 trades that all expire on the same monthly option. And that is what I want to warn investors against. So I hope that helps answer your question, Michelle. Daniel, your question about Qualcomm, if you don't mind sending me an email for me to look up that exact trade before I can reference it. I just don't want to give you any wrong information. Michelle is saying, hi, Tony. When I look at the charting graph on OptionsPlay, the support and resistance appears computed with data far in the past very often. I may be wrong. Should I use support and resistance for options evaluation short-term or going long-term on stock? So, I mean, it is based on 1 year's worth of data to calculate that support and resistance. So if you're trading very short-dated options, they may not be very applicable to you. If option volume is 4.5 times puts, does that include the stock will go higher or lower? So this is the thing, Ed. Unusual volume means nothing in terms of directional view. It just means that there are more puts traded than calls. That's it. It doesn't the puts could have been sold, could have been bought. You don't know. That's what unusual volume is. This is why I'm not a big fan of unusual volume. I tend to find that a lot of investors who are not very educated or maybe not fully sure of what this is, they'll see, 4.5 times puts traded on NSC, that must be bearish. Let me go buy some puts. But what if these puts were sold? That would be a very bullish view on this particular stock. What if it was a closing transaction, meaning someone who had bought some puts are now buying them back? You just don't know. And you have to be able to know those things in order to infer that information. And unless you have real-time time and sales, and you can look at the trade itself, you can figure out what the trade was, you can backward engineer who traded it, what they were trading, and intelligently understand what they were trading. And the thing is that you don't have an understanding as to what other positions this person has, right? So if someone puts on a put position here for NSC, what if they're long 10 million shares of the stock and they're buying some puts to protect themselves? They may not necessarily be bearish on the stock. They're just trying to buy some protection. Or if you see a bunch of calls being sold, maybe someone's selling a covered call. There's just so much other things that you don't really have information. You're basically making an inference with incomplete information. At best, you're making an educated guess. But many times you're making a guess with incomplete information. You could be getting it completely wrong. And trading and using that as a trading strategy, in my opinion, is not one that I'm willing to risk my money on. If you have 5 or more positions, how do you keep track of the movement of the positions so you know when a position loses 50% or gains 50% of your value? So that's a good question. If you're putting on, you should always have the ability to stay on top of your positions. If you're trading more than positions than you have the ability to stay on top of, then you should not be trading that many positions. So if you don't have the time to track 5 positions, don't trade 5 positions. I don't know what else to tell you then, other than you should have a general, if you're trading these types of options, you should generally be looking at your account in the mornings when the market opens, get a sense for where the market opens, where you are, if any of them have kind of near stop loss or take profits. The other thing that I talked about here last week was setting up an OCO order. I set up OCO orders on all of my trades because I don't have time to sit in front of my screens, glued to my screens, to know when I have to take profits and when I have to cut my losses. TD Ameritrade on the Thinkorswim platform, I can set up OCO orders to protect myself on both sides. I have an automatic take profit, automatic stop loss. When one gets triggered, the other one gets canceled. So I don't have to sit in front of my screen. Do you want to set up your credit spread trade so that the theta is positive? So pretty much all credit spreads have positive theta. Unless you're selling an in-the-money credit spread, they're always going to be positive theta. How do you roll over fixed option gone bad on year over year? So this is something that I cover quite heavily in my trading psychology video. So I highly recommend you to go to the OptionsPlay hub, look at the options education. I recently hosted one on trading psychology. I highly recommend that you take a look at that. Let me see where that is. I will add this to the trading. I'll add the trading psychology video to the options education one, where you can see all of the options education sessions here, the recent ones here. So this is where you can look at all of our previously recorded sessions. But I recommend that you take a look at my risk management trade if that's your line of thinking. With the out of the money credit spread, we can be more directionally natural, since right now we do not know the direction of the market. So again, to each their own. If you feel like you have no sense for the market and you want to sell these out of the money credit spreads, there's nothing wrong with that. Just understand that you're risking more to do it. That's it. Daniel, right now we're only covering the NDX, NQX index options. We are looking at adding SPX. I don't think we'll be adding RUT. There's just not enough volume. I mean, these exchanges charge us tens of thousands of dollars to add these types of indices and display them. That's the challenge here. NASDAQ, we work with NASDAQ and they've given us the ability to display these to you guys. And that's why we offer NDX, NQX. But RUT, Russell, do not want to work with us and want to charge us tens of thousands of dollars to do it. So that's why we don't offer RUT on our platform. Back to out of the money credit spreads. A lot of questions about out of the money credit spreads. More risk can be managed by stops to utilize a higher pop, correct? So Michael, in theory, yes. But the problem with these higher out of the money credit spreads is that many times what you'll find is that you're just going to end up getting stopped out. And then if you didn't place a stop, you would have been profitable in the long run. That's the challenge here with these stops. Yes, in theory you can, but our back testing shows when you sell out of the money credit spreads and you put on that stop, more often than not, you're going to get stopped out, even though if you didn't get stopped out or if you didn't place that stop, you would have been profitable in the long run. According of what you just said about pop, most important thing about entering a new credit spread is to do it at a point where you are highly confident in the direction. Not necessarily, Fernando. Certainly direction is big part of the picture, but more importantly, you want to only enter credit spreads where the income that you're receiving is a very large portion of the vertical spread. That's more important than anything else, because the more you collect, the less risk you take. The less risk you take, the less directional rightness you need to have, or the more right you need to be on the directional view. Because the more you collect, the larger the buffer you have, the more, even if the stock goes against you, you can still be profitable on the trade. Tim, all of our sessions are always recorded and you can access it through the OptionsPlay hub. What analysis goes into your short put report? There's no analysis that goes into the short put report. It just finds you the optimal short put for all of the stocks in that list. So optimal being 45 days out and the 30 to 40 delta range. Thinkorswim used to close out 5 cent out of the money option, no cost. Not sure is still done. So most brokerage firms will allow you to close out and out of the. First of all, brokerage firms are not allowed to charge you more commission than the cost of the trade. So you can't like close out something for 5 cents and then get charged $10 in commissions. But you can close out of the money options these days for very cheap these days, especially with zero commissions. On the unusual volume, MKE has 141 call and put for 115. That is the market view that some are bullish and some are bearish. Again, Gary, that is not an accurate statement. Just because 11,995 call puts were traded on Nike at the 115 puts, it doesn't mean that those puts were bought. They could have been sold. So you don't know. So this is, again, why I don't like to use unusual volume, because at best, I'm making an educated guess based on my experience as a trader. And, generally speaking, I tend to find that guys that have been on the institutional desks have a little bit more visibility and have a little bit more experience seeing institutional flow and saying, I think I have a pretty good idea what this trader was thinking when they're placing that trade. But if you guess that wrong, or if you have incomplete information and you only see one side of the trade and you forgot to see the other side, and you saw one put, but you didn't see the other one, it was actually a spread or a diagonal. So you see that the April, 115 puts were traded, but you forgot to see that some other, maybe June 130 puts were traded. And that was actually part of a diagonal strategy. And you're only looking at half the picture and you make a trade off of that. Guess what? You could easily trade the exact opposite of what that institutional trader was trying to do. So trying to follow in someone else's footsteps when you have half the picture or very incomplete information is a dangerous game, in my opinion. And that's why the evidence pretty much shows that by trying to follow unusual volume, the net alpha that you generate at the end of that is a big fat zero. How do we use unusual volume? Great question. You can't really use it. I mean, if you were... this is some of the stuff that we used to do on the desk. We used to try to figure out what someone was doing. But again, that's just an educated guess. And if you have enough experience sitting on an institutional desk and you see institutional traders put up large trades, maybe they called you and they were telling you what the trade was, and you've seen enough of this and you kind of have that information, that's one thing. But if you're a retail trader without access to the right tools, without access to real-time time and sales, I tend to find that this information many times is not very useful. On the call credit spreads, do you ever buy your high leg on the dip to run unlimited on the call you own? Not sure what that means, Will. Buy your high leg on the dip to run unlimited on the call you own. I really am not sure what you mean by that, Will, if you don't mind clarifying. Daily trades tracking, will this be made available on the hub? Yes, Thomas, that is something that I will add to the hub. Tom, you're very welcome. Do we adjust vertical spreads or close it if the trade is not moving in your direction? So generally speaking, my rule of thumb is to close out a trade that's not working out. A lot of people try to adjust their positions. When you talk about adjusting, there's really two things that you're doing. You're either taking on more risk or you're kicking the can down the road. Those are the really only two things that you can do with a losing position. And you're kicking the can down the road, hoping that perhaps you can get yourself back to break even. And what you're doing is you're just really extending some emotional pain in time, right? Whenever you have a loss, it's always hard emotionally to accept that loss. But the one thing I've learned as a strategist over the past 15 years is that successful traders, they cut their losers quickly and they move on and they spend all of their time managing their winners. They manage their small winners into big, big winners. That's how they succeed in trading. They don't become successful by turning all of their small losses, hopefully getting them back to back into the green. That's not how you become successful in the long run. You can avoid some losses there, right? But many times that causes you a lot of emotional pain to try to kick the can down another month by hoping that you get back to break even, because usually at best you get back to break even. Rarely do you turn a small loss into this huge win. And it just doesn't make sense to spend all of your time trying to deal with all of these small losers. Cut those losers, get them out of your hair. Focus on your winning positions. Focus on the trades that you got right. Focus on the stocks that you got the call right, and figure out how to turn that call option that you first purchased, roll them into another call option so that you can turn that small winner into a much larger winner. Let your losers go. I can't tell people enough. I mean, I preach this stuff from the rooftops. Not everyone listens, but I hope someone does. And I hope someone learns from this, because that shift in thinking changes the way people trade. So many investors that I see that struggle that in this frustrating kind of cycle of small winners, small losers, small winners, small losers, and sometimes taking that big loss. It always comes from traders that focus too much on not wanting to take a loss. And from a human nature perspective, I completely understand that. No one wants to lose. No one wants to be wrong. So in the pursuit of not being wrong, in the pursuit of not wanting to lose, that's usually when we have our biggest losers, because we keep trying to adjust our positions. We sometimes take on more risk, and we turn a small loser into a much larger loser. That's how we lose at trading. To succeed at trading, you need to cut those losers. When they're small losers, cut them. Get them out of your hair. This way you don't have to think about them. And it's easier to let go of small losers than it is to let go of a much larger loser. And then focus all of your attention on the trades that are going in the right direction, the stocks that you got the right view on, the stocks that you called correctly. Focus on those and make sure that you continue to extract as much value and as much profit from those trades as possible. That's how I've seen successful traders continue to succeed. The At the Money straddle report is empty. Let's take a look. It doesn't look empty to me. Nope. Looks like there's plenty of trades in the At the Money straddle income report. Do you recommend using butterflies? I'm not a big fan of trading butterflies, because trading butterflies is effectively a shot in the dark. And you're going to lose probably 4 out of 5 times. And that one time that you win fairly sizable. You get it right. You get the pin on the trade. But the problem with it is that it's a very low probability success trade, and it's not a very warm feeling to lose 4 out of 5 trades. It's just not something that, generally speaking, works out well in the long run. What percentage do you close a losing buy call option? The rule of thumb for a long call is to cut your losses at 50% of the premium that you pay. That is the general rule of thumb. Okay, I have really tried to cover as many questions as possible here. I've answered almost an hour worth of questions here. But I really hope that this was helpful for everyone to get some insights into, what we covered here for the month of March. Access to the OptionsPlay Hub, which is a great tool for all of you that have been asking us, where do we get access to the recordings? Where do you get access to the reports? This is all for you in one place, easy to remember, optionsplay.com/hub. And then we have a lot more features coming out here in the next couple of months. So really looking forward to showing you that, guys, over the next couple of weeks. So thank you so much. I hope you guys have a great trading day. You'll be able to see the recording of today's session in the options education session here later tonight on the OptionsPlay Hub, so that you don't have to wait for our email. You know that next time you want a recording, you head over to the hub and you'll be able to see everything there. So with that, thank you so much. And I'll see you guys tomorrow morning on our thematic investment series. We're going to be talking about 5G and IoT. Thank you so much and have a great evening.